Today, we will talk about double entry in accounting and how it's used. Double entry is a bookkeeping and accounting method, which states that every financial transaction has equal and opposite effects in at least two different accounts. It is used to satisfy the accounting equation, where assets equal liabilities plus equity. In accounting, a credit is an entry that increases a liability account or decreases an asset account. A debit is the opposite. It is an entry that increases an asset account or decreases a liability account. The double-entry accounting system records transactions in terms of debits and credits. All types of business accounts are recorded as either a debit or a credit. Business transactions are classified into accounts, including assets, liabilities, equity, revenue, expenses, gains, and losses. Bookkeeping and accounting track changes in each account as a company continues operations. Debits and credits are essential to the double-entry system. Debits refer to entries on the left side of an account ledger, and credits refer to entries on the right side. The total of debits and credits for a transaction must be equal to be in balance. Double-entry bookkeeping was developed in the mercantile period of Europe to help rationalize commercial transactions and make trade more efficient. It forms the foundation of the balance sheet, ensuring that all uses of capital equal all sources of capital. Every business transaction will be represented in at least two accounts. A bakery purchases a fleet of refrigerated delivery trucks on credit for $250,000. The debit entry increases the asset balance, and the credit entry increases the notes payable liability balance by the same amount. Double entries can occur within the same class, such as a credit to cash and a debit to assets when purchasing with cash. In single-entry accounting, a business records each transaction in only one account, while double-entry accounting records each transaction in at least two accounts, providing a holistic view of a company's transactions and financial picture. The primary disadvantage of the double-entry accounting system is that it is more complex. It requires two entries to be recorded when one transaction takes place, and mathematically, debits and credits always have to equal each other. An example of double-entry accounting would be if a business took out a $10,000 loan and recorded it in both the debit and credit accounts, making a debit to cash and a credit to debt. Under the double-entry system, both the debit and credit accounts will equal each other. Here are two key takeaways. 1. Double entry refers to an accounting concept whereby assets equal liabilities plus owner's equity. 2. The emergence of double entry has been linked to the birth of capitalism. Hope this would help. Thanks for watching.